Let me ask you something uncomfortable. You've been saving money your whole life. Every month you cut back on spending, you put money aside, you watch your bank balance grow. And you feel responsible. You feel smart. But what if I told you that saving money is actually making you poorer? Not because you're doing something wrong, but because of a silent enemy that steals from you every single day. And most people never even notice it. Today, we're going to talk about the real math behind saving versus investing. And by the end of this video, you'll see money in a completely different way. Stay with me because the numbers are going to shock you.
Let's meet two people. Same age, same income, same starting point. First, meet Sarah the Saver. Sarah is disciplined. She works hard, spends carefully, and saves $500 every single month. She puts it all in her savings account at the bank, which gives her a 4% annual interest rate. She feels safe. Her money is there. She can see it, she can touch it, she can withdraw it anytime. After 30 years, Sarah has saved $180,000 from her own contributions. With the bank interest, her total balance, roughly $346,000. That sounds pretty good, right? But wait, there's something Sarah forgot to account for. Inflation. Inflation is the silent thief. On average, inflation runs at about 6 to 7% per year in many developing economies, and even in the US and Europe, it historically averages around 3%. Here's what that means in plain English. The $346,000 Sarah has in 30 years, it won't buy what $346,000 buys today. In real purchasing power, she's actually behind where she started. She saved her whole life, and she's poorer for it. Now meet Ivan the investor. Ivan also earns the same income as Sarah. He also saves $500 a month, but instead of putting it in a savings account, Ivan invests it in a simple, diversified index fund that tracks the stock market. Historically, the global stock market has returned an average of 10% per year before inflation and about 7% per year after inflation. Let's use the conservative number, 10% average annual return. After 30 years, Ivan's $500 a month has grown to $1,130,000. Over $1 million. From the same $500 a month, the same 30 years, the same starting point as Sarah. The difference, $784,000. That's not a little difference. That's the cost of a house. That's generational wealth. That's financial freedom. So what created that massive gap? Two words: compound interest. Albert Einstein, whether he actually said this or not, was credited with calling compound interest the eighth wonder of the world. And the math proves why. Here's how compounding works. When your money earns a return, that return gets added to your total. Next year, that larger total earns a return. Then that even larger total earns a return, and on and on. It's interest on interest, growth on growth. Wealth building on itself. Let me give you a concrete example. You invest $10,000 today at 10% annual return. After year 1, $11,000. After year 5, $16,105. After year 10, $25,937. After year 20, $67,275. After year 30, $174,494. You put in $10,000. You got back $174,000. You didn't work for that extra $164,000. Your money worked for you. Now compare that to putting $10,000 in a savings account at 4%. After 30 years, you'd have about $32,434. Same $10,000, same 30 years, but the investor ends up with 5 times more money. That's not luck. That's not timing the market. That's just math. Now let's talk about the thing nobody wants to talk about, what inflation is actually doing to your savings. Let's say inflation is running at 6% a year, which is very realistic in many countries. Your savings account is giving you 4%. That means your real return is -2% every year. Every single year, you are losing 2% of your purchasing power. So let's track what happens to $100,000 in a savings account earning 4% against 6% inflation. After 10 years, your balance shows $148,000, but in today's money, it's worth only about $82,000. After 20 years, your balance shows $219,000. In today's purchasing power, around $68,000. You saved more, your account balance went up, but you can actually buy less than when you started. This is the trap millions of people are stuck in, and most of them have no idea. Now, I know what some of you are thinking. Let me address the most common objections. Objection number 1. Investing is risky. I could lose everything. Yes, investing carries risk, but here's the truth. The stock market has never had a 30-year period in history where it ended lower than where it started. Not once. Short term, it goes up and down. Long term, it has always gone up. The real risk isn't losing money in the market. The real risk is running out of money in retirement because inflation ate your savings. Objection number 2. I don't have enough money to invest. This is a myth. You can start investing with as little as $10 a month today through index funds, ETFs, or investment apps. The barrier to entry has never been lower. The only thing stopping most people is knowledge, and now you have it. Objection number 3. I need to time the market perfectly. No, you don't. In fact, trying to time the market is one of the biggest mistakes investors make. The strategy that consistently works is called dollar-cost averaging, investing a fixed amount every single month regardless of what the market is doing. This way, you buy more when prices are low and less when prices are high, and it smooths out the volatility over time. So what should you actually do? Here's a simple, actionable framework. Step 1, build your emergency fund first. Before you invest a single dollar, make sure you have 3 to 6 months of expenses saved in a savings account. This is your safety net. This money is not for investing, it's for emergencies. Step 2, eliminate high-interest debt. If you have credit card debt at 20% interest, paying that off is a guaranteed 20% return. Nothing in the market can beat that. Clear it first. Step 3, start investing consistently. Once your emergency fund is set and your bad debt is gone, invest every month. Automate it if you can. Treat it like a bill you have to pay. Even $100 a month invested over 30 years at 10% becomes $226,000. Step 4, diversify. Don't put all your money in one stock. Index funds and ETFs automatically spread your money across hundreds of companies, reducing risk while capturing market growth. Step 5, leave it alone. The hardest part of investing is doing nothing. Don't check your portfolio every day. Don't panic when markets drop. Time in the market beats timing the market, every time. So let's bring it all together. Saving money is not bad. Sarah wasn't wrong to be disciplined. The habit of setting money aside every month is essential. But if you stop there, if you only save and never invest, inflation will quietly erode everything you worked for. The real math is clear. A saver earning 4% while inflation runs at 6% is losing money in real terms. An investor earning 10% annually, compounding over decades, builds real wealth. The difference isn't income, it isn't luck, it isn't timing, it's knowledge and the courage to act on it. You now have the knowledge. The question is, what will you do with it? If this video changed the way you think about money, hit the like button and share it with someone who needs to see it. And subscribe, because every week we break down financial concepts that the school never taught you. I'll see you in the next one.